Good morning. I'm Mark Jenkins, head of Carlyle's Global Credit Platform. I'm excited to speak with you today about the strong credit business we've built, the growth we've achieved to date, and how we will continue scaling our platform. Our approach to growing this business embodies the strategic priorities that Q laid out earlier today. First, we created a diversified platform with an eye towards scaling it. Second, with our platform now in place, we are focused on areas where we believe we can continue capturing growth. And third, as we have done from day one, we will ensure global credit is aligned with and leveraging the strengths of Carlyle by operating as an integrated global team that collaborates across the firm. Today, our platform spans a broad credit risk spectrum built on three major pillars: liquid corporate, illiquid corporate, and real assets credit. This range of capabilities allows us to provide tailored capital solutions to borrowers and, importantly, deliver attractive risk-adjusted returns to our investors, depending on their individual investment needs. As we have ramped up our capabilities and product offerings, we have achieved significant growth. We've more than doubled assets under management in 5 years, and we will continue to scale the business even further to over $80 billion in the next 4 years, with a focus on doubling fee-related earnings over that same period. So how will we achieve these outcomes? First, we'll seek to capitalize on strong sector tailwinds. For the past several years, private credit has been one of the fastest growing asset classes, and we expect that trend to continue. Secondly, we'll capture that growth by leveraging the firm's global presence and strengths, and by operating as an integrated global credit platform. And finally, as we grow, we will keep our focus on delivering attractive performance for investors while pursuing a measured growth plan for our business. Before I discuss how we'll scale global credit, let me first provide more detail on our platform today. Over the past few years, we have focused on building a broad, deep, and diverse credit investment platform. This approach allows us to deliver a range of investment solutions to meet our limited partners' needs, while also enabling us to pivot to where the new opportunities are through a credit cycle. When we started building this platform, we did so based on a solid credit foundation that goes back over 20 years, starting in CLO management. Today, our CLO business is fully scaled with over $28 billion in assets under management and is one of the leading CLO managers globally. From that strong foundation, we expanded into illiquid credit, launching our credit opportunity strategy and materially increasing our direct lending capabilities, both areas benefiting from secular trends in the lending market and where we saw the most scalable and most immediate growth opportunities. We expanded in real assets credit as investors look to diversify their credit portfolios. And for this, we added aviation and infrastructure credit capabilities. We then grew our liquid credit offerings to include CLO investments and revolving credit investments to round out our liquid strategy. And lastly, we began offering cross-platform credit vehicles, providing investors access to all of our underlying strategies in a single vehicle, which is a tangible example of how this platform is helping us serve our investors better than ever. Through all of these actions, we created a platform that gives us tremendous operating leverage as we continue to grow, while improving the segment's operating margins for our shareholders. With our platform in place, our focus over the next 4 years will be on scaling it to take advantage of that operating leverage. Our path to more than $80 billion in assets under management is based primarily on our plan to scale our existing strategies, with a focus on 4 key areas. First, in direct lending. As we've expanded that strategy, we have benefited from the growth in non-bank lending to corporates and sponsors and continued to expand our role in larger transactions across different funds and vehicles. We will, as Q mentioned previously, benefit from the consolidation of allocations to single managers and are poised to materially grow in this area. Next, opportunistic credit provides solutions for borrowers in need of capital for complex situations that are not well addressed by the traditional capital markets. We've already seen a lot of demand for this form of capital, and based on historic deployment in this space, believe it is an area with a lot of growth potential. Next, infrastructure credit is a sector with an estimated global spend of $3.7 trillion annually through 2035. So we expect increasing demand for private debt funding. At the same time, we're seeing increased appetite from our LPs in this low-rate environment as they rotate allocations out of longer-dated traditional fixed-income strategies into infrastructure credit. Finally, cross-platform vehicles. They provide two discrete advantages. First, the ability for us to develop tailored credit investment strategies for investors who want access to our entire global credit platform in a single vehicle and at scale. Secondly, they help maximize our operating leverage as the investment capital is deployed alongside our current strategies without increased human capital. Beyond scaling our existing strategies, we'll look to extend it to new adjacent areas where we again would exploit the One Carlyle advantage. Real estate credit is an area we currently invest in out of our illiquid strategies, but we are preparing to launch as a dedicated strategy. And we feel that this is the right time for us to pursue real estate credit given the recent global reset that is occurring in this sector and the increased interest we're seeing from investors. We'll also continue to lever our geographic footprint that we have as a firm, specifically in Europe and Asia, where we've historically maintained a strong presence with dedicated resources on the ground for many years in both regions. And we expect these activities will get us to at least $80 billion in AUM. Incrementally, strategic M&A would put us well over that target. It is important to note that any M&A activity we pursue would need to meet strict criteria. And as you heard earlier from Q, any deal would have to be accretive, scalable, fit us culturally and institutionally, and it would have to be something we would not be able to build organically over a reasonable time frame. This is the plan that will scale our platform. As we execute on this plan, we do so in an environment where current market dynamics are primed for significant growth. So let's walk through what those strong tailwinds are that support our industry. As you can see, the private credit markets look dramatically different than they did over a decade ago. Banks used to be the primary providers of credit and liquidity in the leveraged credit markets. Over time, financial regulators have forced banks to deleverage their balance sheets, and this has dramatically reduced capital allocated to leveraged credit assets by those very same financial institutions. As a result, private credit investors, such as Carlyle, have stepped in to fill the lending void left by those very same banks. We believe the growth of private credit as an asset class is only just beginning. Private credit is essentially where private equity was just over 15 years ago in terms of assets under management. We believe that the same fundamental drivers we experienced with the growth of private equity will continue to drive private credit growth over the next several years. First, a lower return public market environment that leads to a rotation from public into private investments. And secondly, companies and management teams are choosing to remain private for longer periods of time. Couple these factors with the bank retrenchment from the leveraged lending space, we expect the increase in private credit investments over the next several years to continue. On the investor side, as interest rates and yields have come down to near historic lows over the past 30 years, and we expect they will remain relatively low compared to historic levels for a prolonged period of time, pension funds, insurance companies, endowments, and other large investors continue to seek higher yielding credit alternatives to help them achieve their portfolio target returns. In their search for yield and return enhancement, they have allocated more to private credit. And this is precisely why we built our platform to include the complete range of leveraged credit products. We can meet investors' needs for the more liquid, lower risk strategies, all the way up to more illiquid, higher yielding strategies, given our range of offerings across the credit spectrum. We can tailor solutions to each investor through a suite of our offerings or directly into our commingled funds. As we capitalize on these market tailwinds, what will differentiate us and why we are confident in our ability to take our commensurate market share are the developed advantages that come from being part of the Carlyle ecosystem. Today's market is more competitive than ever and requires an ability to move fast. Informational advantages and relationships are key. It's all about having an edge and making better, more informed credit decisions, which we get from being part of a global team. with the industry and company knowledge to both originate and structure deals well. For every company logo you see here, and this is just a small sample, we have leveraged Carlyle's resources to create an investment opportunity for investors. Whether that's drawing on the capabilities of dedicated diligence teams, gleaning insights from over 255 global private equity portfolio companies worldwide, or leveraging the expertise of our in-house operating executives who represent a number of different industries, it all gives us the Carlyle edge to originate and analyze prospects and help add value after an investment. These advantages enable us to provide optimal solutions for borrowers and better risk-adjusted returns for investors. In addition to the strengths we get from being part of Carlyle overall, we benefit from working together as one global credit-focused business. And as you know, this is a platform we have spent a lot of time building. The end result is a strong credit business with capabilities to scale from an origination, investment, and capital raising perspective. For instance, through our platform resources, we have access to information from hundreds of credits at any given time. We share information derived from those positions to make better relative value decisions and to be more selective on where we deploy capital. As a result, we close on less than 5% of our overall originations. This deliberate and highly selective investment process has led to average default rates for our US CLO business that is over 2/3 below the market average. On the capital raising front, we have a dedicated product development and investment relations team that allow us to service our LPs better by tailoring solutions specific to credit investors' needs. High-quality investor service is critical not only to attracting new investors, but also in maintaining the existing relationships we have. And what we've built is clearly resonating with our investors. We raised over $10 billion last year across the platform as we continue to build momentum with both existing and new investors to Carlyle Global Credit. As we draw on the resources of Carlyle and our credit platform, we remain focused on delivering strong performance as we grow. Ultimately, our growth and success is dependent on delivering attractive performance for our limited partners. We're not asset gatherers. We're not doing deals for the sake of doing deals. We're focused on delivering strong performance across a range of assets. What investors are looking for is a level of consistent and persistent returns across a broad credit risk spectrum. Private credit has demonstrated through cycles that it can deliver these outcomes, and as a platform have demonstrated our ability to deliver. It all comes down to performance. Over the course of this presentation, what we've shown is that we've created a purpose-built platform that meets the specific needs of our limited partners and borrowers and is ready to scale. We are in a strong position to benefit from the incredible market tailwinds, and as we continue to leverage the power of being part of Carlyle and deliver the performance our investors have come to expect, we will take our commensurate market share. We've already achieved significant growth over the past 5 years, and as we execute on our strategy, we will grow our platform to over $80 billion in assets under management by 2024. And we expect fee-related earnings to outpace that growth over the same period, resulting from the operating leverage we've created with our platform. We're proud of what we've achieved so far, and given the size of that market opportunity and our ability to capture that growth, we're even more excited about what lies ahead. Thank you.